Get everything set up. Okay, it says we're live. Just getting the other screen on. Shout out to everybody for pulling up to the stream, man. This is very, very important. Okay, so we got the chat open. Make sure as soon as you pull up, you drop a comment. You know, just so I can know who's actually, you know, pulling up. I got you in attendance. Yesterday's class was extremely dope. That was, you know, it was definitely fun to be able to go over that information and seeing all the feedback that we got, you know, was very powerful. So, you know, we definitely got to keep this going. So also shout out to y'all that catch this later on in the course material. You know, this is going to be some very powerful information. So we're starting today with chapter 3 and moving into chapter 4. So make sure y'all pull up, man. I'm gonna give y'all a few minutes. We're gonna give it about 5 minutes, 10 minutes maybe at the most to let YouTube get the notifications out. So in that time, if you want to skip straight to the material, if you're watching this later on, you can just kind of fast forward a little bit. But otherwise, just enjoy the stream. Shout out to everybody pulling up. Drop a comment ASAP so I know that you're in the building. Hit that like button so others can find the stream as well. And do not forget to share it. Don't be stingy. So let's see. Okay, got that set up. Got this. Okay, cool. Market definitely rebounding today. Seeing a nice pickup, 6.97%. So we could just round that up to 7% today. We seen Bitcoin break back over $20,000. Right now it's back under that 19. It's at 19,961 right now. Ethereum at 1,074. So depending on when you're watching this, these prices might sound like an absolute discount. Right now we got a lot of people panicking in the market because of the recent, you know, crash or whatever you want to call it. This, to me, nice healthy correction that's given us the opportunity again to make our money, make us even more money. So pull up, make sure y'all hit that like button, man, ASAP. If you're just getting in, I'm gonna give the stream a few minutes to allow everybody to get in here. You know, we got a couple people at work still and things like that. You know, so they gotta, you know, get the stream open and, you know, get their headphones in or Bluetooth or whatever. Okay. Salute to everyone for pulling up. Make sure you hit that like button, share the stream ASAP. Shout out to Blue Ice, man. Appreciate you for pulling up. I appreciate your videos. This gives me more hope as a crypto investor. I've been studying Bitcoin for about 5 years now. Salute. I'm glad that you are pulling up and taking your education and investing serious. A lot of people don't do what you're doing right now. This is the time that a lot of people try to duck. You know, a lot of people want to be around for the quick, you know, buy this and pray that their money goes up. But a lot of people don't want to pull up to the gym and actually have to put that work in. So this is that time right here. Shout out to everybody pulling in. Make sure you hit the like button. Share this also. Share the stream. Let's get this out. Again, the book is Economic Indicators for Dummies. For y'all that want to get the book to be able to follow along with the classwork. So we'll be doing at least 2 chapters every single day. So we should have this book done in about, it's about almost 20 chapters, about 19 to 20 chapters. So we'll have this book done, and we might do some days where we do more than 1 class in 1 day. So this book will be done within the next 10 days. That's why I asked y'all, you know, is this worth to you the next, being able to put the next 30 to 60 days in, 60 to 90 days in to really turn up your education. So that way you'll be prepared and know, you know, what to do and being able to be confident behind the decisions you make in the market during this rough period. Is that worth it to you? Or do you want to just continue to, you know, move about the markets? Because I know a lot of people I talk to, they've been in crypto for a while, they've been in stocks for a while, but they just been floating by. They haven't really been doing anything to level up their education. So, you know, I truly believe if you put 60 to 90 days into this, studying hard, your life will change forever for the better. Because once you learn this information, you know, in a way, kind of, I don't want to be cocky with it, but you feel unstoppable in a way, because now you put everything in your hands, where now you have the opportunity to be able to make almost as much money as you want to make. Not saying you could just, have a money printer, but you'll know what to do in all these different difficult times, and the good times, the bad times, the uncertain times. You'll know how to make money. I believe 60 to 90 days, your life will change, and you'll never have to look back, especially for those that are just getting started and learning, or don't know where to turn. This information is for y'all, the ones that are serious. We got Blast in the chat. Salute, Blake. Salute. Appreciate y'all for pulling up, broski. For you, appreciate you pulling up. Shout out to Harlan. Appreciate you pulling up, bro. Shout out to everybody. Make sure y'all hit that like button so others find the stream. Share this information as well. I'm telling y'all, this will be course level information, or at the very least, well, for sure this will be course level information, but ain't no telling how long it'll be available on the channel. So I highly recommend you, watch this information. Go watch chapters 1 and 2 after this video as well, if you haven't caught that, and get this rounded information, so that way you can become a better informed investor. I'm going to make a lot of people this year and the next year to come their first 6 and 7 figures. If you want to be one of those people, make sure you tap in. A lot of people ask where to start. This is where you start, in class. You could try to get lucky and, just roll the dice. But, look what happened to a lot of people right now during this time. A lot of people didn't understand to take profits. They didn't even know where to take profits. And if you would have been following along this information that I teach in my courses, the information I teach on the channel, inside my private investment community, you would have knew to at least take some cherries off the top along the way. So tune in. We're going to give it about another minute before we actually get the class started. And again, for y'all that are new, we got economic indicators for dummies. Now, our class yesterday, this is how powerful this information is. Go check out the video. We go, let's pull this up. Let me share the screen with y'all. Hold on, let me do something real quick. Okay. So if we come take a look here, let me show y'all this. This is how powerful this information is. So we're taking a look at my channel right now. You can see this video yesterday. This was yesterday's class. We had 811 people show up to this class, y'all. That means a lot of people are taking this information serious and, trying to get ahead. So make sure that you're one of them people, man. Share the stream, get the word out. Blue Ice said, he took that one. Blake said, what's good, bro? Appreciate y'all all pulling up. Blue Ice said, I'm getting those books now too because of you. 100, what kind of books would you recommend I get? The books that we got here on the stream. I told y'all, you can't find this type of information on any YouTube channel that's really breaking it down for y'all, holding your hand, walking y'all through this information with experience. And that actually cares about the meme coin space. So salute, shout out to the Sheep Army, shout out to the Volt Army. OG Ocean Grown said, I have candlestick charting for dummies. I'm definitely getting some more books. Okay, that's what's up. I like to hear that. I like to hear when people are getting those books and really taking it serious, man, because those are the ones that see the best returns. The people that's too lazy, too tired, too scared, too whatever to actually pick up a book or do their due diligence and spend the time in class, too bad, too sad, man. It's a thing called smart money and dumb money. This is what smart money does. Smart money pulls up to the gym. Blue Eye said, I'm getting a new big home here in Texas and I ate roaster one day. I am manifesting and speaking that into existence. Thank you, God. Salute. You definitely got to do that. If you want something, you have to speak it into existence and know that you can make it happen with hard work. So let's jump over here to the list of currencies. Salute to Hank L. Peace King. Appreciate you for pulling up, man. Blast said, that's no lie. There really isn't a channel quite like this one. Leading us by hand is exactly what it is and what we need. WMO pulled up, said back for some more. So shout out to y'all. Okay, we got people pulling up. Now we're gonna get into this. We had over 800 plus people pull up to the class yesterday. So if y'all are in right now, y'all are one of the first people pulling in. We're gonna have a lot of people that ended up catching this later on. So salute to the, I'm not sure how to pronounce that, Maury Warrior Rongo King. Appreciate you for pulling up, bro. Shout out to everybody. Drop a comment even if you're catching this stream later on. This is very important. Keeping track of, the people that continuously pull up, those that support, engage, all that is important. So now we left off yesterday talking about, setting short and long-term interest rates. We talked about how interest rates have a direct impact on the economy's ability to grow. Low rates generally facilitate economic growth, while high rates generally impede growth. So you can see that's what's happening right now with the Federal Reserve. Jerome Powell, chairman, increasing our interest rates by 0.75 of a point or 75 basis points. He's attempting to impede the growth a little bit, to slow down inflation, to to curb some of the reckless spending. I'll say, some of the frivolous spending, people buying things that they really don't need. Remember they talked about durable goods and and how people during the rougher times, people are less likely to make big purchases because of the commitment. They're uncertain about their paychecks. So what we're seeing is the inflation tried to be combated by raising these interest rates, which right now will kind of slow things down, which will all feel an effect on it through the market, through our prices and things. We see gas prices up, food prices up, everything is up right now. So hopefully, over the next few months, we can kind of, tone it down some. I do expect him to continue to raise interest rates over the next meeting. I believe we'll be meeting again in July, to determine what they'll do at that point, to see how this 75 basis points or 0.75 of a point basically affected the market. So now we're moving into chapter 3, which is understanding the big picture, the economy and its footprints. So salute, drop a comment so I know y'all pulled up. Shout out to Essence for pulling up. Salute. Essence said, I'm going to catch up on the live that I missed yesterday. Okay, that's what's up. So now we got chapter 3, understanding the big picture, the economy and its footprint. So in this chapter, we'll learn about cycling through the economic landscape from periods of growth to recessions. Very important for what we're facing right now. Surveying the 4 main financial markets. Very, very interesting. Y'all are going to like that. Identifying the ins and outs of economic reports. Also determining an indicator's market impact, timeliness, and relevance. These are all 4 very important things. To be able to add this to our repertoire, is powerful. So let's get into this. Before digging into individual economic indicators, you may want to take a step back and also drop y'all comments. If y'all got any questions or comments as we're reading, drop them. I'll take breaks periodically and get to the comments. So before digging into individual economic indicators, you may want to take a step back and view the big picture. What exactly is the economy anyway? Put simply, it's you and me and all the other people who go to work, buy things, make things, and sell things. It includes businesses, banks, shops, shoppers, contractors, and employees. In short, the economy is the accumulation of all business transactions throughout a particular country or the world, if you're talking about the global economy. You can make this definition a whole lot more complicated if you want to, but why do that when the simple definition is at least as good and offers the benefit of clarity? So let's go over that one more time. So what is the economy anyway? Put simply, it is you and me and all the other people who go to work, buy things, make things, and sell things. It includes businesses, banks, shoppers, contractors, and employees. In short, the economy is the accumulation of all business transactions throughout a particular country. So if you're talking, or throughout a particular country, or the world if you're talking about the global economy. You can make this definition a whole lot more complicated if you want to, but why do that when the simple definition is at least as good and offers the benefit of clarity? Of course, no matter which definition you use, the economy also includes the government, After all, most bureaucrats long for a starring role in the economy. In fact, they generally want their fair share of every business transaction in order to keep the government's coffers full. Although the economy's natural tendency is to grow, it never grows straight ahead. So you need to pay careful attention to where it's been and where it's heading as you make your investment decisions. This chapter looks at the regularly recurring economic patterns of growth and recession. It also shows you how economic indicators report on the condition of the economy, how some indicators fall in and out of fashion with the times, and how you can use economic indicators to improve your investing and business strategies. Powerful information. Shout out to Jonathan Fu for pulling up. Make sure y'all hit that like button. Those that potential moderators, make sure y'all let everybody know to hit that like button. Also to subscribe and turn on notifications. So taking a closer look at the business cycle, history may not actually repeat itself, but it sure comes close. The history of economies is littered with manias and depressions. In fact, economies go through business cycles and travel the road from boom to bust so frequently that you think they'd occasionally try a different route, but they never do. One boom differs from the next, but you can count on people to eventually buy too much, overextend themselves and their pocketbooks, and have to pull back. One boom gains momentum from excitement over the newfangled internet, which makes shopping a cinch. All you have to do is start a new internet company and you're sure to get rich, right? Escalating housing prices drives the next boom. And the one after that, who knows? So it looks like we're kind of in that phase right now. The economy booms may not end in exactly the same way, but every expansion so far has ended in recession. After all, the economy has to slow down to recover from all the spending that occurred during the boom. The following sections explain in greater depth what business cycles are and how the economy moves up and down. Identifying the phases of the cycle. Some economic experts quibble about the definition of an economic cycle. In fact, some even claim that the economy isn't cyclical at all and is instead a system of economy-wide fluctuations. Call it what you will, the economic or business cycle is a useful way to describe the not quite cyclical phenomenon of expansion and contraction, boom and bust, that occurs over and over again in the economy. As you can see from the graphic depiction of a business cycle in figure 3.1, cycles of boom and bust are easy to identify, at least in hindsight. Each phase of the business cycle has recurring characteristics. So one of those are peak. At the business cycle's peak, most businesses are thriving and prices increase along with personal income. Unfortunately, all is not well. Interest rate climbs as investors and the Federal Reserve worry about the risk of rising inflation. New home construction slows a bit as higher prices and higher interest rates make homes less affordable. Aren't we seeing this take place exactly right now, y'all? We're seeing this take place to the T right now. That's why this is so important, to really get this level of understanding so that way you know what to do. Let's pull up Bitcoin's price in the back just so we got a price tracker going as well. Go to the 1 minute chart so we get that nice price action. Okay, so new home construction slows a bit as higher prices and higher interest rates make homes less affordable. Unemployment starts to creep up as the construction industries and related businesses slow. The next point, recession/contraction. After a peak, the economy slows down. Sales of consumer goods, especially durable goods like cars and kitchen appliances, begin to slow. Businesses respond by slowing production and possibly laying off workers. Personal incomes fall as unemployment rises. Interest rates fall. The popular definition of recession is an economic decline that falls short of a depression. This isn't very useful, given the imprecise definition of depression. So some economists clarify by saying that a recession must be 2 or more consecutive quarters of economic decline. Remember, I told y'all when the GDP falls 2 quarters in a row, which we already had that happen once, and rounding out this next quarter, if that happens again, we will technically be labeled in a recession. So I told y'all, get ready to start hearing that word. Shout out to KDub1 for coming through with the super chat, man. Appreciate that. I definitely will be going over all these books. We got economic indicators right here, and economic indicators for dummies. Definitely want to tap in on this one. This is the one we're going over today. We'll also start possibly doing, a couple different classes each day to cover a couple different book topics. But let's continue with this real quick. So, the trough, the economy eventually slows its decline as it tries to find its footing. Lower interest rates eventually stimulate consumers to start shopping. One of the first signs of an economic trough is often bargain hunting for houses. Housing doesn't always lead the economy out of a recession, but it does often enough that the housing market is well worth your attention. So let's go over that again. The trough. The economy eventually slows its decline as it tries to find its footing. Lower interest rates eventually stimulate consumers to start shopping. One of the first signs of an economic trough is often bargain hunting for houses. Housing doesn't always lead the economy out of a recession, but it does often enough that the housing market is well worth your attention. And the last point, recovery/expansion. As the recovery blooms, industrial output picks up, as does demand for durable consumer products. Employers are reluctant to hire at the beginning of a recovery. Instead, they ask their existing workforce to work overtime. Eventually, jobs become more plentiful as businesses become confident that the economic expansion is going to last. So here's a look at the business cycle right here. The peak, contraction, the trough, the expansion, and the peak. Here's a look at that just so y'all can take, get an idea what that actual graph looks like. So you can see the peak, the period of the period of expansion, the trough, contraction, and then expansion, and then peak again. Where's that contraction? No, that's expansion right there. So from this way, we got peak, contraction, trough, expansion, and peak again. So that's the cycle. That's the cycle. That's what basically we are seeing play out right here. Shout out to Curtis pulling up. Shout out to Shawnee W for pulling up. Appreciate y'all. Make sure y'all hit that thumbs up like button. We had over 800 plus people pull up to class yesterday. So make sure y'all drop a comment in the comment section. Salute to everybody that's coming to get this knowledge. So as an added benefit. Oh, wait. We almost skipped. Hold on. My bad. Okay, here we go. So better late than never. Identifying recessions and recoveries. This is very important for what we're going through right now, y'all. Before the 1930s and the Great Depression, any economic downturn was called a depression. Today, most of these downturns would be considered recessions instead. Neither term really has a formal definition. Some economists consider any severe, sustained economic downturn to be a depression. Others claim that the downturn must last 3 years or more, or account for at least a 10% decline in economic activity before it can be considered a depression. Regardless, the United States hasn't seen anything like the Great Depression, the period from 1929 through 1933, when the economy was cut roughly in half, or its aftershock in 1937 and 38, when the economy declined by more than 18%. The National Bureau of Economic Research, NBER, is the final authority on the matter. The NBER's Business Cycle Dating Committee, BCDC, identifies economic peaks and troughs in the United States. The BCDC looks at the economy's entire output of goods and services, employment, personal income, and industrial production to determine when a recession begins and ends. The NBER doesn't provide a formal definition for recession, but researchers know it when they see it. Although they use the term contraction rather than recession and expansion rather than recovery, the BCDC believes its research approach provides a better indicator of when the economy is in expansion or contraction than using only one or two economic indicators. The rest of this book for details on individual indicators. Unfortunately, the BCDC isn't quick about making its announcements. Case in point, by the time the NBER declared the start of the 2007-2009 recession, it had been underway for 12 months. Likewise, in September 2010, the NBER announced that the recession had ended in June 2009. That sounds crazy to say, 2009. So 14 months after the fact, plus when the NBER makes a declaration, it's not the final word. The Bureau's pronouncements are always subject to revision, though they rarely occur. You can keep up with the NBER's economic announcements on the NBER website at www.nber.org/cycles/main.html. And you can find a record of economic cycles going back to 1857 at www.nber.org/cycles/cyclesmain.html. This particular site shows economic peaks and troughs by listing the number of intervening months from one peak to the following trough. Although the NBER definitively identifies a recession beginning and end, it delivers its reports so late that they're of little use to investors or business leaders, which is why savvy investors track the economy and economic indicators on their own. By staying abreast and anticipating these economic trends, you can identify when the economy has become overheated and improve your performance as an investor or business manager. You probably can't duplicate the thoroughness of the National Bureau of Economic Research's economic analysis, but you can arrive at a conclusion that's remarkably similar. As an added benefit, you can act on your personal assessment long before NBER publishes its report. Growing into expansion. For the economy to grow, people have to buy things. The more people buy, the faster the economy grows. After all, consumer spending attributes to a very large portion of economic growth. From toothpaste to automobiles, consumer purchases drive domestic production along with the demand for foreign product imports. Service industries like healthcare and restaurants also depend on consumer spending to grow and prosper. Consumer spending causes companies to make more products, hire more workers, expand product facilities, and provide more and better services. See Chapter 6 for details on consumer spending in Part 3 for the lockdown on business products and services. To spend, consumers need money. More jobs and better paying jobs provide consumers with the money they need to spend. Of course, consumers can also borrow money to continue their spending habits as long as personal incomes are increasing. Lenders are usually willing to lend money to consumers for housing, automobiles, travel, or anything else they want to buy. From the economy's point of view, where the money comes from doesn't matter. What matters is that it comes. Just remember, when consumers borrow to fuel their spending, that spending and the subsequent economic growth can't last forever. Slowing into recession. As the economy grows, investors and the Federal Reserve start to worry about inflation. The Federal Reserve's primary defense against growing inflation is to raise interest rates. Higher interest rates make borrowing money more expensive for consumers and businesses. See Chapter 12 for more on inflation and Chapter 8 for more on the Federal Reserve. As the monthly payments for purchases rise, people start to pull back on spending. Big purchases like houses, pay attention, that's happening right now as we speak. Cars, appliances, and furniture are the first to go. As interest rates rise, people can't qualify for the loans they need to buy these items. As consumers' spending slows, the economy heads for its peak and ultimately for a recession. The cycle starts over again. Stimulating with government spending. The government has a few levers it can pull to influence the economy. The main one is setting interest rates at the Federal Reserve, but many economists argue that government spending can also stimulate economic demand. Unfortunately, the effectiveness of government spending for stimulating economic growth is still up for debate. One camp points to the recent trillion-dollar stimulus packages and says that the 2007-2009 recession would have been much worse without the stimulus. The other camp argues that the trillion-dollar borrowing caused the recovery to remain sluggish, hampered private investment, and kept unemployment high. There's little doubt that in certain cases, government spending can be good for the economy, but the argument for increased government spending might be more persuasive if the government hadn't had to borrow the stimulus money. Besides, driving the deficit higher, the stimulus borrowing may have crowded out private investments. After all, the economy has only so much money to slosh around. If it all goes toward government spending, the private sector will get squeezed. Although increased government spending can create government jobs, little evidence suggests that government stimulus spending leads directly to increasing private sector employment. Thus, in most situations, government spending is a poor substitute for private investment. So, reviewing the key financial markets. Today, most people are at least familiar with the major investment markets. Although investments in stocks, bonds, and commodities used to be the province of the very rich, growing numbers of Americans now at least have some assets invested in a 401k and other retirement programs. The investment markets are very sensitive to the state of the economy and the business cycle. Hence, economic indicators are very useful tools for investors because they can help you see where the economy is now and where it's heading. Armed with this information, you can improve your investment results. This section looks briefly at the impact the economy and the business cycle has or have on the major investment markets. Investing in stocks. When most people think of investing, they think of stocks. When you own stock in a company, you own a small portion of that company. Hence, stocks are called equity investments because stockholders own an equity position in the company. Many investors today hold mutual funds and exchange-traded funds, ETFs, instead of holding stocks directly. Although these approaches are significantly different from directly owning stocks, the general concepts are the same. Funds that invest in stocks rise in value as prices for the fund's underlying stocks positions appreciate. Like the business cycle, the stock market has repeating tendencies, and different stock sectors perform well during different phases of the business cycle. You can use the sector rotation model, which was first published by Sam Stovall, the chief investment strategist for Standard & Poor's, to help identify the stages of the stock market and the current stage of the business cycle. So this was created by Sam Stovall, the chief investment strategist that worked for the S&P 500. So here he has the market bottom, a bull market, market top, and then the bear market. And you can see how it aligns basically with the business cycle as well. So I'll show y'all that graphic. Shout out to everybody pulling up, man. It was over 800 students in the class yesterday, man. This information is very valuable. You won't get this anywhere else. Nobody's taking the time to really, make this simple and, easy to consume for everybody. So pull up, hit the like button, hit the subscribe button, join the fam. Make sure you got the notifications on. Drop a comment so I know that you're in attendance. Shout out to Kofu Blue. Kofu was in class yesterday. Jonathan said, thank you, my brother, for the class because you are reading exactly what's happening now. Exactly. A lot of people, if you're able to connect the dots, this is exactly what's happening right now. So you could play around, and think these classes aren't important. But you'll be one of those people that are, just floating around the market for, a year or two and really, haven't learned too much. Shout out to Carlos Anderson for pulling up. Appreciate you for pulling up. Again, drop a comment so I know that you're in attendance. We had over 800 people yesterday. A lot of people didn't drop a comment. I want to know that y'all are in attendance so I can see who's paying attention. And at the end of class, we might have something to give out. So, just pay attention. But here's that graph again. Let me show y'all one more time. Okay, so you can't set your watch by this model, but you can get some general clues about the state of the stock market and the overall economy by tracking different stock sectors. The sector rotation model divides the stock market into the following 4 broad stages. Salute to Oz. Shout out to Lee pulling up. The sector rotation model divides the stock market into the following 4 broad stages. Market bottom. The values for broad stock market indexes like the Dow Jones Industrial Average and the S&P 500 are at their lowest. So that's a market bottom when everything is at their lowest. The market bottom coincides with the lowest prices for many stocks. Bull market. Prices for most stocks and broad stock market indexes are rising. Market top, the values for the broad market indexes and for many stocks are at their highest. Bear market, prices for most stocks and broad market indexes are following. So those are the 4 different stages that you can that the sector rotation model divides the stock market into. So those are 4 stages. So now we'll this is some fire information, man. Pay attention, take some notes. But shout out to Marcus Tate for pulling up. During these 4 stages, you often see recurring patterns in which certain sectors of the market perform better than others. These patterns intersect with the economy and business cycle. Here's an example of how the stock market and business cycle generally correlate. So early bull market. The stock market tends to lead the economy during an early bull phase of the market. Stock prices for many stocks begin to rise. However, the economy is still in recession. The business cycle is still declining and heading for a trough. The stock market generally anticipates the coming improvement in the business environment. So-called cyclical stocks and technology stocks are often the leaders in an early bull market. Pay attention to that. So-called cyclical stocks and technology stocks are often the leaders in an early bull market. Cyclical stocks are those that perform well when the economy is doing well. Investors try to get in on the early actions, causing the prices of these stocks to rise. Cyclical stocks include steel manufacturers, construction companies, auto manufacturers, and consumer durable good companies. Technology industries include software companies, network and communications equipment suppliers, computer companies, and semiconductor manufacturers. Now that's the early bull market. Now we move to the middle bull market. As stock prices continue to climb, the economy reaches its trough as it gets ready to come out of a recession and begins its recovery. Industrial stocks often do well in this environment. These stocks include aerospace companies, farm and construction equipment manufacturers, industrial equipment suppliers, machine and tool manufacturers. Now, the late bull market. The economy begins its recovery while stock prices continue to rise. Basic material stocks start to perform well. These stocks include industries such as agriculture and specialty chemicals, aluminum, and other industry metals, as well as oil and gas producers, refineries, and other energy producers. So let's go over that again. The late bull market. The economy begins its recovery while stock prices continue to rise. Basic material stocks start to perform well. These stocks include industries such as agriculture and specialty chemicals, aluminum, and other industrial metals, as well as oil and gas producers, refineries, and other energy producers. So basically, when you start seeing every stock in a mama start to doing well, you know something's, we getting into that late point of the bull market. When everybody's making money, usually that's when I know. When I start seeing everybody in a mama that jumps in, is making profit, that's a sign that we're nearing that, that end of that bull market. So market top. The economy is doing really well, but stock investors are beginning to get nervous. Experience tells them that the expansion won't last, but at the same time, stocks of energy companies and precious metals companies begin to do well. These stocks of energy companies are doing well because the demand for energy is growing, which pushes energy prices and energy stock prices higher. Prices for precious metals are rising because investors are getting nervous about the possibility of inflation, and precious metals, and to a lesser extent, the stocks of precious metals companies, can be a hedge against that risk. Be aware that the stock market doesn't always get that timing right for this phase of the business cycle. Investors are a skittish bunch and have been known to cause more than a few sell-offs before the economy actually heads into recession. So let's go over that again. Prices for precious metals are rising because investors are getting nervous about the possibility of inflation. And precious metals, and to a lesser extent, the stock of precious metal companies, can be a hedge against that risk. Be aware that the stock market doesn't always get the timing right for this phase of the business cycle. Investors are a skittish bunch and have been known to cause more than a few sell-offs before the economy actually heads into a recession. So early bear market, and try to, I see if you can identify some of these times, if some of these times are familiar to you. So early bear market, the economy hasn't peaked yet, but experienced stock investors are heading for the exits. Instead of cashing out completely, they often put their money in relatively lower risk or less volatile stocks. like those of companies that produce things that people use every day, basic consumer staples, in other words. Food and beverage companies, pharmaceutical manufacturers, cosmetic companies, and manufacturers of household products like soap, shampoo, dishwashing, detergent, and toothpaste are all examples of basic consumer staples, because those are the things that people are going to need regardless of how the economy is performing. People are going to want to shower. People are going to want to brush their teeth. People are going to want to, clean their house, so that's going to, happen, regardless. Also, middle bear market. The economy has peaked and is now heading for a recession or contraction. Stock prices continue to fall. However, stocks of service providers like healthcare companies, auto parts retailers, drugstores, and food wholesalers tend to hold their value in this environment. So, try to identify where we are now. Late bear market. The recession is in full swing. Investors are looking for a place to park their assets. Stocks of financial companies, including banks and insurance companies, often do well in this environment. Let me say that again. The recession, so this is the late bear market. The recession is in full swing. Investors are looking for a place to park their assets. Stocks of financial companies, including banks and insurance companies, often do well in this environment, as do stocks of dividend-paying utilities, such as electric companies, gas companies, and water service companies. This information is fire, y'all. Hope y'all taking notes, man. Salute to Jesus for liking the video. Appreciate you for pulling up. Shout out to Koshan for pulling up. Appreciate you. Said, yeah, what other YouTubers are doing this? December is going to be up soon. Shout out to Sub-Zero for pulling up. Appreciate y'all, man. Kashan said, gratitude, bro. Appreciate all y'all. Shout out to Kevin again for pulling up. We had over 800 students pull up to class yesterday. Leave a comment so I can know who y'all are and, also get y'all in attendance. Now, market bottom. The business cycle is still in recession. Investors are looking for the next big thing. In anticipation of a new bull market, transportation stocks and cyclical stocks begin to perform well again. Now, pay attention. Have we seen transportation stocks and cyclical, or however you say that, cyclical stocks begin to perform well again? Have we seen that happen? I wouldn't say just yet. So we can tell by, the business cycle that we technically haven't hit a market bottom just yet. Still got some room to go. So although the sector rotation model's main purpose is to help investors identify the current state of the market. Tell me this ain't useful, y'all. Tell me the sector rotation model is not useful when you understand this information. Now, you might have to watch this stream again, go back and check it out. But when you start to be able to put all this together and paint this picture in your head, it helps you become so much more knowledgeable and confident about what you're doing and where we are. So that way, that fire or that panic that you have inside of you can, you can ease that. You can have fire in a good way, motivation and inspiration, but you don't want to be like, burning up with, worry. I just don't like to see my, people worrying or, panicking or stressing themselves out. That's why we put this information out here so you have the opportunity to become better informed investors. Now, let's keep going. Although the sector rotations model's main purpose is to help investors identify the current state of the market, it's also useful in helping economic forecasters gauge the state of the economy. It's by no means a perfect tool, but it does offer insight into the current state of the economic cycle. Holding bonds. A bond is basically just a loan. Borrowers issue bonds, and the investors who buy the bonds lend the money to the bond issuers. The borrower gets the money up front. In exchange, the lender, the bond buyer, receives interest payments until the bond matures. Zero coupon bonds are one exception to this rule. I discuss them later in this section. At the bond's maturity, the lender receives the final interest payment along with the repayment of the original principal amount of the loan. I got somebody calling in the class right now, but although, oh my bad, y'all. Let's see. I discuss them later in this section. At the bond's maturity, the lender receives the final interest payment along with the repayment of the original principal amount of the loan. For a variety of reasons, risk-averse investors favor these fixed income investments over equity investments. That's not to say that bonds are without risk. Even the highest rated bonds are subject to price fluctuations as interest rates rise and fall. But bond investors are generally more concerned with the continued stream of interest payments rather than the current price of the bond, because many bond investors hold their investments until maturity. The biggest worry bond investors have is inflation. Bonds and bond prices are extremely sensitive to inflation because the value of the interest payment declines whenever inflation is high. So remember, when inflation is high, the value of interest payment declines. In a low inflation environment, interest rates tend to stay low and bond prices stay high. As inflation concerns rise, so do interest rates. The direct relationship with inflation makes bonds very sensitive to the business cycle and the economy. See Chapter 6 for details on inflation and Chapter 14 for details on interest rates. Here's a very brief survey of the types of bonds that are available, listed in order of their risk profile. U.S. Treasury securities. The United States borrows a lot of money. Even so, U.S. securities are considered to be among the lowest risk loans in the world. So low, in fact, that the risk of default is almost non-existent. The U.S. Treasury handles all these loans. Short-term and long-term loans go by different names. Treasury bills. These very short-term loans have maturities of 1 year or less. Treasury bills don't pay interest. Instead, the Treasury sells them at a discount to face par value. At maturity, the investor receives their face value. So basically, you get a discount on an asset that's valued higher at the end of the maturity time. Treasury notes. These loans have maturities often 1 to 10 years. Treasury notes are interest-bearing securities. Treasury bonds. Probably the best known of the Treasury securities. These loans have maturities that range up to 30 years. Treasury inflation-protected securities, also known as TIPS. These bonds are for inflation-wary investors because they're indexed for inflation. If inflation goes up, so does the biannual interest payment. If deflation rears its ugly head, the bond's interest payment falls. At maturity, the bondholder receives either the face value or the inflation-adjusted principal, whichever is higher. Municipal bonds. The federal government isn't the only borrower. States, counties, cities, school boards, and various other government agencies like airports and water utilities all use debt to finance various projects. So if you ever wondered where they get this money from, this is where they get it. When these state and local government entities borrow, their bonds are called municipal bonds or munis. Interest on munis is sometimes tax-free. The federal government doesn't levy income taxes on munis, and state governments rarely tax in-state munis, although states may tax out-of-state munis. The two types of munis are general obligation bonds. The full faith and taxing authority of the government, municipality that's borrowing the money backs these bonds. They're often the low-risk munis and therefore often the lowest interest rates. Revenue bonds. Instead of backing the bond with the full faith and credit of the borrower, the government backs some bonds with the revenue stream from a specific government asset. Examples include civic arenas, airports, and water utilities. These asset-backed munis may be riskier and therefore pay higher interest rates than traditional general obligation munis. Check out a couple comments. Shout out to everybody still tuning in. Drop a comment if you haven't already. You got to make sure them notifications are turned on. Salute, Kashawn. Appreciate you for pulling up. You know, even if y'all, got to pull up and, you want to stay tuned for the whole class or just leave it playing in the background if you got to, just so you can, subconsciously soak up this information, even if that's the case. But nonetheless, just come tap in, mark in for attendance. Let me know you pulled up. And then, come back later and catch the stream when you can. Remember, we had over 800 people in the stream or come to class yesterday. So, leave a comment so I know that you did pull up. Also, let adjust something real quick. Yeah, this is very, very valuable information, y'all. Hit that like button. We got over 200 views on the stream. Over 200 views on the stream with only, it looks like 38 likes right now. Y'all got to run those likes up, man. We had over 800 people in class yesterday with only 114 likes. Y'all really got to get those likes up, man. You can't find this information anywhere else. So show some love, man. But let's keep going. Corporate bonds. Corporate borrowers also use the bond market to raise capital. Corporate bonds range from very low risk to relatively high risk. Investment grade bonds. Some institutional investors, such as insurance companies and pension plans, may invest only in bonds with a relatively low risk of default. That's why bond issuers hire bond rating agencies to evaluate the risk of each bond and bond issuer and to assign the bond a rating based on their evaluation. Non-investment grade bonds, also called junk bonds. Non-investment grade bonds have a higher risk of default. They pay higher interest rates to compensate for the higher risk to the lender. Most bonds in the United States are issued for a fixed interest rate and a fixed term to maturity. In addition to these traditional bonds, some borrowers often or offer the following variations on the bond theme. So callable bonds. These bonds give the issuer the right to repay the bond before maturity. Both munis and corporate bonds are sometimes issued with the call option. Callable bonds. Convertible bonds. The convertible feature of some corporate bonds allows the bondholder to exchange the bond for a fixed number of shares of the company's stock. Floating rate notes. These bonds have a variable coupon rate, which means that the interest payment is adjusted based on a reference rate, like the London Interbank Offered Rate or the federal funds rate. Zero coupon bonds. These bonds don't pay interest. Instead, they're sold at a discount to their face value. The investor receives the face value when the bond matures. Treasury bills are an example of zero coupon bonds. Inflation adjusted bonds. These bonds are linked to an inflation rate measure, such as CPI. Usually the principal value is adjusted based on the CPI. The interest payment is then calculated from the inflation adjusted principal amount. Although not common, corporate and muni inflation adjusted bonds are sometimes issued. TIPS bonds are an example of an inflation adjusted bonds. Trading commodities. The commodities markets span a wide range of products. Commodity products are either purchased directly from the producers or sold through a standard exchange. Though transactions can occur in several different ways, the most economically sensitive markets include the following. Cash markets. Commodity producers and purchasers sometimes buy and sell commodities using cash market, also called spot market transactions. The buyer pays the current market price, sometimes called the spot price, and the seller accepts payment upon delivery. There are a few centralized cash market exchanges for trading high volume commodities like gasoline and natural gas. However, most transactions are handled directly by the buyer and seller through local cooperatives or through a specialized commodities brokers. More commodities trade in cash markets than in futures markets. Futures markets. A futures contract is a standardized form of forward contract that's bought and sold on a futures exchange. Forward contracts specify the commodity, the quantity, and the delivery terms. Futures exchanges such as the CME Group, formerly the Chicago Mercantile Exchange, provides physical and electronic trading facilities. Much like stock exchanges, each futures exchange sets its own contract standards. However, in the case where multiple exchanges trade the same commodity, contracts are generally similar. Examples of commodities traded on futures exchanges include agriculture, soybeans, wheat, corn, cotton, orange juice, coffee, sugar, meat, and livestock. Industrial metals, copper, aluminum, and steel. Precious metals, gold, silver, platinum, and palladium. Energy, crude oil, gasoline, and natural gas. Commodity producers and users often use commodity markets for hedging, a technique used to offset or minimize the risk of adverse price movements. Prices of these agricultural and industrial commodity products are generally very sensitive to both inflationary pressures and the economic cycle. See Chapter 15 for more on commodities and the markets in which they are traded. Tracking currencies. The value of a currency, like the Japanese yen or the US dollar, is directly tied to the strength of the local economy. In the case of the US dollar, its value is high when the US economy is strong and growing. It's low when the US economy is in decline. Inflation also has a significant effect on the US dollar. When the United States experiences inflation, the value of the US dollar declines. These relationships between the local currency and the local economy hold true for all currencies. Cashing coupons. The interest payment on a bond is sometimes called the coupon or coupon payment. The term coupon is a holdover from the days when bond certificates were issued with coupons attached. The bondholder would clip the coupon and cash it in at the bank. Bonds with coupons attached were generally known as bearer bonds. Unlike most bonds today, bearer bonds are unregistered. In other words, nobody tracks the ownership of the bond. The bearer bond's interest coupon is payable to the holder of the bond. Due to changes in the U.S. tax code, newly issued bearer bonds are generally not available in the United States. If you've ever traveled overseas, you've intuitively understand the nature of currency trading. When you go to the bank to exchange dollars for an upcoming trip, sometimes your dollars buy more of the foreign country currency, and other times they buy less. For example, assume that you're a U.S. resident. If you book your trip when the dollar is strong, but it falls by the time you take the trip, your trip becomes more expensive even if overseas prices remain constant. The idea of investing in currencies is similar to exchanging dollars for a trip, but it generally takes place on a much larger scale. Large currency investors, such as banks, exporters, and importers, primarily use the highly leveraged foreign exchange markets to hedge against currency exchange risk. For example, the United States imports a great deal of product from overseas producers. U.S. importers pay for imports with dollars. If the value of the dollar falls relative to the local currency, the overseas producers can lose money on the transaction because of the change in exchange rate. The exporter can protect against that loss by selling dollars in the foreign exchange market. Speculators and central banks also have a role to play in currency trading. Speculators that trade currencies hope to profit from change in exchange rates. Those are people that you hear trading things like Forex and things of that sort. Central banks use the foreign exchange market to manage the money supply. See Chapter 8 for details. Individual investors may also invest in currencies by using mutual funds and exchange-traded funds. Figuring out what's what in economic reports. Each month, dozens of economic reports are released from a variety of sources, both public and private. The U.S. government is the largest publisher of economic data about the U.S. economy. Fortunately for you and me, it makes its research reports and most of its data freely available on the internet. Privately generated reports are often available by paid subscription, but some publishers provide excerpts to the public at no charge. In the following sections, I explain what information is essential in the reports and how they're assembled so you can focus on just what you need. Finding what's important in each report. Some economic reports are quite simple in terms of what information they present, but many of them are chock full of data tables, charts, graphs, and analysis. You quickly realize that there are too many reports and too much data for one person to fully grasp. Fortunately, you don't need to follow every